Good afternoon, ladies and gentlemen, and welcome to today's session, already our second session of Audit Level 3. And I'm especially looking forward to today's section where we are going to talk a little bit more about disclosures, and not from the point of drafting the disclosures, but of auditing disclosures that the client has already put into their financial statements. I'm really looking forward to that today. Now I see that my slides, I'm going to have to just reshare my slides. Apologies for that. There we go. All right, so this is likely not your first time, but as always, we like to just go through how to work on the webinar and how everything is put together. So as always, all attendees have been muted, but you are welcome to participate, and we actually want to encourage you to please use the question and answer or even the chat function. The chat function also works quite well, and we have activated that for you, so you're welcome to use that. And then if you do lose connection, I know sometimes your fiber or your internet is just not reliable, then you can just join the webinar again and carry on. The sessions are all recorded and they will be made available. I have learned that some of the recordings will be made available next week. So there are a few already on the Success Community and on YouTube, but there are a few that will come through next week as well. All right, so that is first of all with the administration. We would like for you to please participate. So yeah, ask questions in the chat or in the Q&A if you want. You can even use reactions. We don't have any polls today. We have a survey at the end, but other than that, yeah, please ask questions, or if you want, I try to ask questions to help you to think through some of the points. So if you want to respond by typing an answer in there, you're welcome to do that as well. Then where to find the resources for today. So I've included the QR code. Also, I included the link to the Success Community earlier on. And if I just go to the Success Community, there I've already gone to the Get Ahead site. So you will see that you can either click on Learner Resources or on the track schedule. And then when you go all the way down on the track schedule to Audit Level 3, you will see for today's session where we have auditing disclosures. That's where the learner files are for you to download. So it's one learner file with also a folder with the slides for today, but then also the working papers, the exercises that we will be working through. So if you haven't downloaded that yet, I want to encourage you to do that. We will be working in the caseware file for a short while at the end in our breakout session, but I didn't include another caseware file in that session. So if you would want to also follow along or anything like that, and you happen to maybe not attend the first session that was there on the 20th of February, then you can also just download that file, for which then contains a caseware file. So that was the file that we used to also work through the finalization stage. So one of the documents that we're going to look at today is part of the finalization stage. And so that will work well as well. Apologies. So yes, that's if you want to follow along in the caseware file. I didn't include another caseware file because it's just a lot of stuff to download, and I'd rather you download the working papers so that you can follow along for those ones if needed. Right. Good. So that is then the Success Community and getting all of that material there. Then I've already asked about the questions, so please participate. If you don't know where the questions are, you will see there on the left, there is where the chat function is. There's also Q&A, and then of course the reactions just on the right of that. All right, it looks like my voice, it's telling me it's been a long day, so I apologize. I hope I'm not going to be coughing the whole afternoon, but I'll also take a sip of water next. Good. The agenda for today is that we are firstly going to look at some of the requirements for disclosures. Remember, we are auditing the disclosures, so we need to see what what is it that the client has to do? Where do we find the requirements? And then we will look at a few examples of how to audit disclosure, and that's going to take quite a bit of time for the session. And then lastly, we will also finish off with seeing how to accumulate the disclosure errors in the different options of the methodology or in the software. And that's where Samu is also on the call. So those of you from the Audit International methodology, you will have joined Samu in the previous breakout sessions as well. So when we get to the breakout session, Samu will step in for the Audit International and show you around there with regards to the disclosure, and then specifically the accumulation of the disclosure, and just to show you what the working paper looks like. And I'll continue with the probe one as we have in the past. All right, so that's what the afternoon holds for us. And of course, we will have a comfort break or two somewhere along the way as well. So that's all up and coming. Right, let's have a look then. I think for the sake of our presentation, I'm going to switch off my camera just because I want to look at the big screen, and then I'm not going to look at you anymore. So I've switched off the camera, but we will be working on the screen and then sharing the information as necessary. Good. So what are disclosures? Well, that's basically, I just want to say very loosely, whatever is in your financial statements that gives information. But now, of course, there's a better description or a better definition of that. And so the standards actually show or talk about explanatory, so explaining, explanatory or descriptive information that is set out as required, expressly permitted, or otherwise allowed by the client's financial reporting framework. One, on the face of a financial statement, so on your balance sheet, income statement, etc., or in the notes, or incorporated by cross-reference. So if we just think about that, the cross-reference part, that is where maybe you have another statement, or if you've got other disclosures included in the same pack where the financial statements are, and your financial statements cross-reference to that other statement or other information that's also in the same pack. So that would be cross-referencing, I was going to say outside of the financial statements to information there. But overall, pretty much the requirements of information that must be disclosed by the financial reporting framework. And as I've mentioned now before, it is with regards to information on the face of the financial statement. So that then being the actual numbers, not just words, but numbers and words, both on the financial statements themselves, as well as then, as I'm sure you would have already imagined, the notes to the financial statements, but also then on those statements themselves. All right. We will need to also consider the requirement paragraphs of the financial reporting framework. So in IFRS for SME, every section has the requirements of what needs to be disclosed. In IFRS accounting standards, you have all the disclosure requirements for each of those standards. So there really is a lot that prescribes them. And then I suppose just on a side note, I think it's probably about 10 years ago already, but when the initial standards were launched back in 2010, the auditing standards now, well, there was always a requirement for disclosure, but then in about 2016, they actually revised quite a few of the standards, and the whole project, and with all the revisions there, the purpose was to actually emphasize the auditor's focus on disclosure. They literally called it the disclosure project. So the auditing standards also has a lot of requirements, and we're going to later on also see how many of the standards have requirements about that. But it really is important that we don't just think about the numbers that go into the statements, but about all disclosures, and of course those notes, the words and the numbers in the financial statements. All right. Just quickly want to see here now. Oh, goodness gracious me. Okay, so if we also just think about the requirements, so we said there that the information may be required, expressly permitted, or otherwise allowed. So requirements is simply when the framework requires it. We've mentioned now IFRS for SME or IFRS. So let's say, for example, the requirement for inventory says we must show the different categories of inventory, and if there is impairment, to also show the number of impairment written off. So that is all required in terms of the disclosure. And so there may be even stories that need to be disclosed in the financials. And what we always have to think about is not just what should be in there because the standard stipulates the categories and things like that. There may sometimes be additional things that you need to disclose or may want to disclose. But then important is almost this part that says otherwise allowed by the financial reporting framework. And that is especially relevant in cases where we talk about fair presentation framework. So your IFRS and IFRS for SME accounting standards, where yes, there are requirements of what must, I almost want to say at the minimum, be disclosed, but then very often you'll have more items to be disclosed, not because the standard requires them or mentions them, but because there may be instances where what you are disclosing is not sufficient to achieve fair presentation. And therefore then that we actually need additional disclosure, otherwise allowed or expressly permitted, but additional information more than just the bare minimum to ensure the fair presentation. All right. Good. Then let me just go to the next slide. When do we care about disclosures in the audit? Now, I've mentioned already this whole disclosure project, but what is important is that we need to realize that actually in the risk assessment process already, we are thinking about and considering the disclosures. So what is the risk assessment process? That is where we perform risk assessment procedures. So things like analytical review, inspections, observations, things like that. And why do we do that? Well, we do it so that we can determine whether there are risks of material misstatement, the risks that the financial statements may be materially misstated. And what do we link those to? We link it to transactions, balances, and disclosures. So if we think about the term accountability is for classes of transactions, account balances, and disclosure. So literally, accountability or class of transaction, account balance, disclosure, that thing that we need to consider if there is a risk of material misstatement at a certain level, that thing already includes the disclosures. So in risk assessment, when we think about, for example, goodwill impairment calculations, we're auditing that, or we're considering if that is perhaps risky. If there's a risk of material misstatement there, we might say, yes, that disclosure of that is actually important. It may be complex to do the calculation of the impairment. It's due to a lot of subjectivity. And then when it needs to be disclosed, when it needs to be impaired, it also needs to be disclosed quite carefully and very specifically. So very often linked to specific transactions or balances will have specific disclosure requirements. If we think about property, plant, and equipment, we have, if I think back again to the financial statement on the balance sheet or the statement financial position, we have the current year, prior year numbers for PPE, but we also have the notes with the reconciliation and showing the depreciation and the additions and all those things, and then even reconciling it to the prior year. So all of those disclosures are then linked to the balance. But then we also have other disclosures that are not necessarily linked to a transaction or class of transaction or account balance. And those could be related party disclosures. It could be your statement of cash flow. It could be maybe commitments and contingencies, things like that, that is not directly linked to an individual account, but needs to be disclosed. Standard says it's got to be there. Even if you think about IFRS 13, the fair value disclosure that's required, those are also additional disclosures that needs to be in the financial statements. And as auditors, for us to ultimately, remember what we're ultimately doing, we are ultimately signing off an audit opinion, not on the trial balance, not on the client's general ledger, not even actually on our audit file. We are signing off an audit opinion on the client's financial statements to see if those financial statements are fairly presented or not, and that includes the disclosures. So risk assessment, there already we are considering and thinking about disclosure, whether there is a risk of specific, let's call it incorrect for now, disclosure, or whether when there is something that is risky, whether we need to check if that has also been properly disclosed in the financials. Okay. Then when we get to the performance, the actual, almost want to call it field work, the performance of the audit work, that is where essentially we need to not just audit up to the TB stage, I almost want to say. You know, in a perfect world, we would have wanted to get the set of financials from the client when we walk into the audit. Wouldn't that be lovely, eh? We get to the client, we start the audit, and the client says, here's my set of financials, please will you audit it? Fabulous. Now we start auditing it, and we go and we do it, the risk assessment, field work, and so forth. And all the while, we've got this set of things, this end product that we have to give the opinion on. As I said, that's a perfect world, right? So how it normally works, of course, is very often you would still wait for the final trial balance. So you might have a trial balance when you start the audit. Hopefully it's a relatively finalized one, but you start with a trial balance, not with a set of financials. And you most probably only get the financial statements towards the end of the audit. Whether it is because the client is still finalizing a few entries, or maybe they are still busy with some of the notes that need to be disclosed and they're still drafting those. So very often we only really get the financials towards the end of the audit. And in the meantime, we are auditing what we have. And what do we have? We have a trial balance that we are auditing. Now, even many years ago when I started doing training on auditing, I used to always say, we audit up to the TB stage and then we take what's been audited in the TB and we go and tested in the financials to see that it's been properly disclosed. But when the ISOs changed with this whole disclosure project, they actually said, guys, we need to think about disclosure from the very start of the audit. We can't only think about it once we are done auditing the TB. We need to actually think about it the whole time. And that's really what I want to encourage you is throughout the audit, we need to be thinking about disclosures. So in finalization, for example, last week we said we need to conclude whether we've obtained sufficient appropriate audit evidence to support our audit opinion. And we just said audit opinion on the financial statements, whether it's fairly presented. Right, so really thinking about disclosure throughout. And another point, not just whether what should have been disclosed is in fact disclosed, but also about whether the information that has been disclosed is not actually misleading, confusing, perhaps not actually obscuring the actual important information. So if there's a lot of additional notes or a lot of notes about immaterial matters, that's actually so causing so much additional information and not really causing chaos. That's almost what I want to say, but rather actually removing the focus from the important parts that should have been the focus of the reader of the financials. And probably just because there are so many notes, they don't know where to focus. So that could also be misstating the financial statements. If there is unnecessary notes there, that is basically giving the wrong message or actually not giving the fair presentation of the client's results, just because there is so much additional stuff there. Okay. Right, so as I said, we're actually using or considering disclosures throughout the whole audit, right from the start. And we are focusing in that black line on this slide. Our focus is not necessarily on every single amount that is disclosed in the financials. You know, the same way that when we are going to be doing risk assessment, we no longer have to audit every single assertion of every single balance or line item in the trial balance or financials or anything. Our focus really is on the disclosures that are considered material. So, or because it can be a combination of where there is risk that the disclosures may not be appropriately done. So where we've actually recorded a risk of material misstatement for the disclosure. Right. So material is considered important or material when it can change the economic decisions of users made on the basis of that information. And so that's why when we think about which disclosures are material, it will be those, not just in numbers again, but in words, in stories, in how it's aggregated. In other words, summarized or disaggregated. Is there just too much information? not sufficiently summarized in the notes, in the disclosures of the financial statements. Right, so also if I think about some examples of the risks and the materiality, we can, for example, have a risk for the valuation of debtors. We're going to test the recoverability of the debtors, the trade receivables. But then when there is that provision, that potential write-off of the debtors, we also want to see that that is actually disclosed as well. So that could then be, let's say, a link to the disclosure of that valuation matter. But then we can also say that we specifically have a risk for potentially incorrectly presenting or disclosing the financial statements through the statement of cash flow. So we are saying the balance sheet and the income statement, the line items in there, we've identified risks and whatnot, but now we're actually recording a separate risk that we are saying there's a chance that the client's financial statements may be materially misstated because the statement of cash flow may be materially misstated. So that's purely disclosures, right? And so there, as I said before, it's about the user's decision based on that information. So very often, when we think about whether whether disclosures are material or not, very often it will come down to almost qualitative materiality and not so much quantitative. So it might be that the number is there somewhere, or the number is not necessarily material, but the way in which it is worded, or the additional story, or the extra words or things that is included in there, that becomes material to the users. Okay, next slide. So there, if we then think about why are we so concerned, I almost want to say, about the disclosures and the testing of that. And I've said now before, we're not just testing up to the point of the trial balance and then only then start thinking about the rest of it. But practically speaking, the disclosures, the financial statements is our end product. It's our result, or the audit report is our end result. And our end result is on the financial statements. So I've got two analogies for you. Firstly, in the whole purpose or in the theme of our racing cars, if we think about the Formula One that just started now last week, Sunday, in case you missed it, so big new season that's ahead of us. In Formula One, there is something that they call a pit wall. Now, the pit wall is a place next to the track where people or the teams of the car drivers are sitting there and they're monitoring their own car of their team to see how they're doing, but they're also monitoring the other cars that they are competing against. And so while they're monitoring and seeing how the guys are doing, and this one is ahead of that one, etc., they're also working out strategies. Things like, for example, when should you come to the pit stop to come and refuel, or what I always enjoy is when it's raining or when it's about to start raining, and every team has a different strategy. Am I going to first go around while it's still raining and try and get a little bit ahead before I go and change to the other tires while everybody else is in the pit stop, or am I going to go first and change my tires? Or there are so many, I almost want to say, scientific considerations in those things. If you drive with your with your rain tires or not your rain tires, etc. Are you going to drive with an, almost want to say, near empty tank of petrol, not having a lot of fuel in your tank, but because you don't have a lot of fuel in your tank, you're going to go faster and try and make up time there? Or are you going to rather go and fill up your tank, or put a little bit of fuel in your tank, maybe a little bit, and then have another pit stop later on so that you never have too much? All of those things are all strategies in Formula One to help them win the race, or try and help them win the race, if you want. Now, you can then see that these guys that sit in the pit wall, they are communicating. They're not just sitting there. They have to basically communicate to the driver to say, right, this one is going into the pit stop now, or when you go there next, then it's time to go to the pit stop, things like that. So they're literally communicating to each other, the driver back to them as well, to say what's happening, what should be happening, etc. They might say, yes, that sounds like a good strategy, so I'll go into the pit next. And then, then the crew knows they need to be ready. Now, imagine if that driver tries to communicate or asks the guys in the pit wall information, but suddenly that pit wall becomes completely soundproof. So they sit there, they can see things and whatnot, but they become unable to communicate with the driver that's on the track. And the same thing the other way. The driver cannot communicate back to them to say, I'm struggling, or whatever, there's a button on my machine, or whatever the case is, what must I do? Do you think I should come into the pit now? What are the other guys doing? Where's this one? Whatever the case may be. So imagine if they cannot hear each other. That is, I almost want to say, complete disaster if you think about it, because they're not going to be able to say, listen, I'm going to go to the pit now, let the crew come out and fill up my car or change the tires or whatever. You know, sometimes they do that. The last time I really watched F1 with Focus, I think they did some of those changes in like 8 seconds or something. You cannot imagine that they can actually fill up a tank, change tires, and do everything else safely in like 8 seconds. It might actually be faster now already. So if they can't communicate, they're going to get to their pit, hopefully still with a little bit of fuel in, so they don't go and get stuck somewhere next to the track because they've run out of petrol. But if they get to the pit, the crew wouldn't have known that they are coming. So the crew's not going to be running out and being ready there. So they're definitely not going to do it in 8 seconds, maybe 80 seconds, which is a disaster. So you can imagine that without that communication between the pit wall and the driver, there is just almost no success or no chance of success. Right, that's the one side to this. Because how do we link this? We link this to say the same that our audit work, the evidence in our audit file, has to link up with what is in the financial statements. If they don't talk to each other, if the information in my working papers, in my trial balance, in my clients' records do not actually reference, agree, reconcile to what is in the client's financial statements, I'm actually not able to. It's actually impossible to give an audit opinion on the financial statements because then I don't have audit evidence of what is in the financial statement. So we have to make that last connection, that link between what is in our audit evidence and what has been disclosed in the financial statements. All right, another story, maybe if the cars wasn't necessarily as exciting, or you just need another way to think about it, is perhaps if we are driving on a road, a really nice, good quality road, no, what are these things, potholes or anything, really good quality, brand new road next to a river. And we know that we need to get to the other side of the river, and we get to the road comes to the river, and we can see the other side, the river, not the river, the road on the other side of the river, and we can see it's really good quality, and we just need to get to that side so that we can carry on with our journey. But there's no bridge. Then I cannot get on with my trip. Then I cannot actually successfully complete my trip. I cannot complete my journey. I cannot get to that road. Yes, there may be some other, I don't know, broken down road on the side of the river, or maybe there's nothing, there's only bushes. Then I cannot go anywhere. I cannot get to my destination. And so then I still, back to the audit evidence, I cannot actually then give an audit opinion on the financial statements if I haven't built that bridge to connect the audit evidence to this client's financial statements. So very often you might find that the partner's on the one side of that river, the partner's spending quite a lot of time on the financials, checking, reading the notes in there, etc. And the team is spending a lot of time on the working papers to see that everything's working. But no one goes and spends the time, I almost want to say, and effort to actually go and connect those two with each other. So not just, just checking, oh yes, there's a note, but actually connecting those two to each other. So neither of them are crossing the river or building a bridge to get the two to connected or linked to each other. So that is really important then, that we make sure that we don't just stop by the river, but that we actually cross the river and make sure that we do reference to the financial statements, that we know that all the effort we've gone to go and audit that section, that's actually also successfully been shown, reflected, etc. in the financial statements. Right, so let's look at the requirements of the financial statement. So first of all, if nothing else, ISA 330, the audit response standard, says the documentation shall, so not just the auditor must, the audit documentation must, we don't have a choice here, must demonstrate that the information in the financial statements agrees or reconciles with the underlying accounting records, including agreeing or reconciling with disclosures, and whether such information is then either within or outside of the general or sub-ledgers. So I mentioned an example earlier on about commitments or even the related parties. You might have the related party transactions recorded in your general ledger as part of your normal transactions. But if there isn't another record, perhaps outside of the ledgers, outside of the accounting records, to say these are the related parties, then you will never be able to determine if the disclosure of related party transactions and balances and so forth is complete. If we think about an example of let's say when there's a lease agreement, so we are renting, there's a lease agreement, and we need to disclose the commitment for the next year's leases, the next 2 to 5, and then more than 5 years worth of leases. If we don't have that lease agreement to be able to check that, then we actually cannot go and audit those sections. So you'll always have the general ledger and the subsidiary ledgers, and those are basically giving you the information about what has happened in the past, so the historic information. But there's also disclosures in the financials about forward-looking or future information, and those cannot be in the general ledger. They cannot be in the subsidiary ledgers. So you have to then go and look at this other documentation as well. Right, so, and again, we have to demonstrate the working papers, the documentation must demonstrate how what is in the financials, that lease agreement, that lease commitment rather, the disclosure of the related parties and the transactions with them, any of those things, how are they reconciled to the documentation that we have from the client? Right. And also, when you are showing how these are reconciled, there's always, you might remember in audit level 1 also, we talk about cross-referencing. So you don't just reference from the working paper to the financial statements. You also need, as part of your audit evidence, you need a draft set of financial statements to reference that back to the working papers, to the audit evidence, to show both ways where everything's gone to. Right. Oh, yes. The other thing also is there's, in terms of this documentation, there are 2 points. The first one is we need to take the underlying accounting record. So basically the trial balance in your lead schedules, we need to go and check that all of those are recorded, disclosed in the financial statements. So yes, you may not necessarily audit every note disclosure. You may not necessarily perform work on every section in the file, but every section in the file's lead schedule has to be referenced to the financials. Let's take a silly example like finance cost or something. Let's say it's not material. If it's not material, you haven't identified a risk, you might end up not doing any detailed audit work on the finance cost. But there's a lead schedule, there are balances in those records, and you need to make sure that they are in fact disclosed in the financial statements. Okay, so we will reference the lead schedules to the financial statements and then go and look at other commitments as well. Right, then other than ISO 330, we also have a bunch of other standards. I mentioned to you the disclosure project. So ISO 200, the audit objective, the ISO 210 engagement letter, 240 fraud, 260 communication, 300 audit planning, 315 risk assessment, 320 materiality, and so we can carry on, estimates, etc. All of those talk about disclosures, even up to the audit report. So definitely a lot of focus on that. And then I've already spoken about what does a SCOTB or COTBD stand for. That D in there is about disclosures. Okay, significant, maybe just as a reminder, significant class of transaction account balance and disclosure is about when there is a risk recorded for that item, then it becomes a significant class of transaction, etc., etc. When it is does not have a risk recorded, then there is no relevant assertion, and then it is just a class of transaction account balance or disclosure. Okay, and I've mentioned now already also that we will always audit, perform work for the material ones as well. So we'll either audit disclosures where there's a risk recorded for it, so there's a significant disclosure then basically, or where we have a class of transaction account balance or disclosure that is material, but for which no risk has been recorded. And then we'll also go and do audit work for that because it's material. We need to at least do some substantive work for it. Right. Then the suggested approach for how we should go and audit this. It looks very simple, 4 little blocks. There we go. But first of all, the point is to first identify that we've got a disclosure that needs to be audited. So when we have to go and audit that disclosure, we will start with that item. So what is the section or the transaction that's going to be disclosed that we need to audit? So I almost want to say, even before the transaction, we basically start with the Scottabody or the material disclosure. Okay, for that item, we'll go and identify the transaction, the section, the whatever it is that's relevant in the financials, and then we will go and look at the requirements from the financial reporting framework. This is important because remember we said the first thing is to make sure that the financial statements are presented in line with the requirements of the framework. So what are the framework requirements before we can go and check that it has been disclosed in that regard? And then we will go and audit the disclosure to make sure that it has been disclosed correctly. And then not just to those lead schedules like we said before, but when the items are material or there's a risk for them, in other words, not the other lead schedules like the finance cost that we just check into the lead schedules. Whenever there was work performed, we need to also check it to the work performed to make sure that we've sufficiently audited that the disclosure is not just linking up, but actually also supported by audit evidence. Okay, we're going to look at a few of those examples. Good. So let's then actually go and start with our first exercise. So I've got 2 exercises, and the first one is we are going to start looking at the statement of cash flows for the client. So I'm going to actually do it on the screen for you or with you. If you have the working papers and you want to follow and do it with me, please, you're welcome to do that. Otherwise, if you want to rather sit back and see how I do it and go and try it yourself later on, that's also perfectly fine. I just want to think what's the best. Oh, in the previous session, I actually made the slide black, then it didn't bother us too much. And then I'm going to go to the working papers, just make it slightly smaller. So in the folder that you've downloaded, you will have the Word document and then 2 PDF documents and 2 Excel documents. So if we just first open up the Word document, we can have a look at the information that's in there. All these 2 exercises. So basically, we just told the following is relevant to the exercises. The risk assessment has been performed and we've identified the following items. For exercise 1, the statement of cash flows, the client does not appropriately disclose amount excluding non-cash transactions, and there is therefore likely misstatements of the amounts disclosed. So we have recorded a medium risk for the statement of cash flows being materially misstated. And why do we believe that? We don't think they are going to exclude the non-cash items or specifically disclose the non-cash items where those are relevant. All right, just for now, so that we also see what we are going to work with in exercise 2, and we're not surprised when we get there. For exercise 2, we have the following risks recorded. For loans with related parties, we are concerned that the disclosure may not be in line with the financial reporting framework. For our client, we're working with IFRS for SME accounting standard, but then we are concerned that that may not be right. We've got a high risk recorded for loans with related parties disclosure. Then other related parties, we are concerned that the disclosure of other related parties may not be in line with the framework because of the sensitivity of the users to this disclosure and the ease with which the manipulation could take place. We have assessed this as a significant risk. So significant risk obviously needs a little bit more effort than just saying, oh, do we have it all right? We need to really verify those users, or sorry, the related parties. And then the last point is just that we've also raised a risk for directors' emoluments disclosure. We didn't identify any inherent risk factor to raise a risk for, but in this client, and remember, that's not always going to be the case, but in this client, the disclosure must be tested to ensure compliance. A very typical scenario here would be a South African company where the company has to, in certain scenarios or certain requirements, disclose the director's emoluments or the director's remuneration. And so that must be disclosed in terms of the Companies Act. That is a legislative compliance requirement. So even though we didn't identify any of the inherent risk factors, we still have to test that that is sufficiently disclosed. And so therefore, there will be work done for that. In fact, we're not going to do that director's emoluments today. We're going to focus on the other two elements in exercise 2. But don't forget that you might actually still have to test compliance, even if there is no inherent risk. Even if from the user's perspective, this is not a material matter, it's compliance, and compliance is qualitatively material. So we will still test that disclosure in that scenario. Good. So that was the information. Then next up, we are going to work on the statement of cash flows. So I'm going to open the client's draft statement of cash flows, as well as then our working paper, where we are going to work on the statement of cash flows, audit the disclosures of the client statement of cash flows. So if you're also working with me, you can open up the the Excel document, as well as the client's draft financials, which is in PDF. I'm just going to minimize that. And there we go. So maybe for those of you that haven't joined other sessions or earlier sessions from our Get Ahead series, if I want to split my screen so that we don't have to flip between the different things all the time, I can simply use a button on my keyboard to split the screen quickly and easily and down the middle. And the way I do that is I use the Windows button on my keyboard and I click the arrows left and right. So I want the Excel document to be on the left, so I'm going to click on the Windows left, and then it will ask me what do I want on the right, and I'm just going to click on that statement of cash flow, and that will be what we are going to see. Right. So the working paper here, doesn't matter what the client's name is or anything. We don't even have the client's name, so that's fine. This is the working paper for the statement of cash flows. We've mentioned that the risk is a medium risk for disclosure. And as we said, we are concerned that the client is not going to remove the non-cash flow items. We have materiality, etc., but it's not actually that very important, or that I almost want to say relevant, because the non-cash may actually be qualitatively material, which is much bigger than just a number. All right, the procedure we need to do says we need to recalculate the statement of cash flows and relevant notes using evidence gathered on file to ensure non-cash items are appropriately treated. Now, what we've got here is, first of all, I actually want to give it a little gray heading so that we can remember this is the statement of cash flows as we have calculated it as an audit team. So all the information on the left-hand side, we've basically drafted from scratch if you want. And importantly here, you will see there are references to lead schedules like 795, 750, 741, those things. But then there are also references to working papers. So that's what WP is. 430.20, 630.20, 347.35, and so forth. So those are all working papers. Why working papers and not just all the lead schedules? Well, because the work might actually be done in working papers which are not, where that detail of the information is not reflected in the lead schedule. So let's say, for example, yeah, in the non-cash items, we've got depreciation, which comes straight from the lead schedule. So that's easy enough. But if we think about something like unrealized profit, forex profit, unrealized forex profit, that information will not necessarily be in my lead schedule. Why? Because the forex profit may be one line item, but it could have realized as well as unrealized profits. So in my working papers, 430.20 and 630.20, on those working papers, I would have then split out the difference. If I'm saying it's probably my team. So a lot of this stuff, it really, like the statement of cash flows and the related parties, is a team effort. Okay, it sounds silly, but you can't go and comb through the whole working file or audit file to find all the information. So if you are reliable or responsible for auditing the statement of cash flows and the disclosure thereof, you really rely on all of your team members to collate the information that you need. So if one person is responsible for, let's say, inventory, for example, then they will be responsible for also making sure that all the information that's necessary for the statement of cash flow disclosure is recorded on them. And the other person will be looking at making sure that all the information for the trade receivables or the loans or the intercompany information or whatever else there is, every person will have their responsibility. Even property, plant and equipment, where we have, where was that? There's one that we're getting to, where they've bought or sold or something, property, plant and equipment, where we can see that there's a cash element there. And again, the team would have had to, whoever did the audit work there, would have had to go and split that and say which part is actually cash and which part of that was on credit. So therefore non-cash purchases in this example. All right. Yes, so I think that is one of the big important winning strategy ways in which we can ensure that we are just one step closer to making sure that the disclosure is appropriate, is to make sure that every team member knows that if there are any specific disclosures to their section for the statement of cash flow and any non-cash items, they need to list that specifically somewhere on a working paper so that we can have all of that information close by. If I say somewhere in a working paper, it doesn't mean that you're going to have one working paper and everybody must run to that one. But if you, for example, have maybe a specific working paper or a number in your section, something like that, that'll say, listen, if there are non-cash flow items, you're going to indicate it on document .13 of my section. Then I can just go and scan through the file and go and identify all the .13 documents, things like that. Okay. Let's just quickly have a look at what we have in here. So the client is drafting on a direct method. And so we will have to redo the same thing. It's almost like us wanting to test the client's controls, but we are coming up with our own controls and then testing those. When you want to go and audit something that the client's done, you need to go and do exactly what the client has done. So here we need to go see, how did the client do it? They started their statement of cash flows from operating activities and then they go through there. And so we need to do the same with our side. Cash generated from operations, cash generated from operations. And then we're going to get to, so it looks slightly different, but it's the same thing we're going to get to at the end of the day, where we want to ultimately get to cash generated from operations. Just in case you are wondering, if you're opening your side, I added this yellow highlight because otherwise I just get confused between where we are. So if you want to do that as well, up to this point, we are basically working on this note of cash flow from operating activities. And then thereafter, we will be working in the statement of cash flows. Okay, good. So we start with the profit before tax. That is recalculated, right? That's our audit evidence that we've recalculated, but where does it come from? So here, for example, we will see the profit per caseware, right? And then the tax per the lead schedule there. Now this, I'm just going to show you any just caseware files that you can see where you can go to try and find it. So here on my caseware file, you can see there's an amount of 3.9 million. That's my net income. So that's basically the profit that we started with here. It's not the same file, so that's why the numbers are not exactly the same, but that's essentially what we would have started with. We've recalculated that profit before tax then. Then the non-cash items that need to go in here is depreciation, right? We're taking that out or adding that back. The profit on sale of assets. So here, that is a non-cash profit. So again, back to the lead 741. Unrealized foreign exchange profit. So the foreign exchange profit was on the bank and cash sections because, oh, sorry, not the bank, so, some of the liabilities and stuff. The trade receivables and trade payables, let me not lie to you, 430 and 630, trade payables and receivables. Then we also have the non-cash movements in loans to group companies, as well as the non-cash movements in loans from group companies. These two items may not be netted off. So it's really important that we actually have those separately reflected. Right. So as I've mentioned earlier as well, you actually go and show that in the working paper where it's been calculated. So that's also why we've reconciled or referenced it rather to the actual working papers themselves and not just to a lead schedule where loans or group companies or something is on a lead schedule. Right. Then the separate disclosure that comes on the face of the income statement, on the face of the statement of cash flows, will be the investment income and the dividends received, and here specifically the cash elements in there of course. And then we've got where we are calculating the change in working capital. There we have the inventory that was calculated. What is the movement or the change in working capital? So that was calculated by using the opening and closing balances. There was no other non-cash items, not because I'm just guessing or hoping or anything, but the team who worked on the inventory actually stipulated that for us. In trade and other receivables, we had the opening and closing balance, but then we had the unrealized forex, which is partially linked to the one there at the top, the unrealized forex profit and loss. The unrealized obviously means at year end we had to calculate it, but it hasn't been realized in that we haven't actually incurred when we paid in this case, the trade receivables paid us, we didn't then actually have that forex loss or gain realizing. So actually had the cash outflow or inflow. It was just an accounting entry at year end. Right. Similar to trade and other payables, we've got the opening, closing balance, and then the unrealized forex profit. Oh, sorry, now I'm hiccuping as well. Whew. So the trade and other payables, there we also have an unrealized forex, in other words, a non-cash, because it was just an accounting entry at year end. Then based on all of these, we then now have that value of cash generated from operations. Then when we get the actual statement of cash flow, we then have the interest income. We have dividends received. So those again come from the lead, but also we took them out earlier on here higher up because we said they come on the lead schedule. We then have the income of the tax paid, the actual cash influence, which was calculated from the lead schedules. And then we've got the note, net cash from operating activities. All right. So that's operating activities. Again, I'm just going to highlight this for us. I want to use a nicer highlight, not just the gray. So you know we always have the operating income, operating activities rather. Oh my goodie. Then we've got investing activities, and we have finance. Oh, goodie gracious me. Financing activities. Okay, just so that we keep all our wits about ourselves. Right, again, the total cash for the year reconciled to the lead schedule, recalculated, working papers for all the financing activities. Here again, you can see these are not netted off. The company loans, repayments of group company loans, proceeds on loans from group companies. These are all financing activities. Cash advances to group loans, group companies, cash receipts from group companies, which are repayments. Those are all investing. Purchases of PPE, look at this one. The working paper 30535 says assets purchased with cash only. So even if there was more purchases of PPE, this 9.6 million is the cash outflow that was used to purchase PPE. What we know is that there was only cash purchases. So actually, practically speaking, in this case, you could also go and agree this to the PPE note that says additions for the year, because those additions are all cash. But you won't always be able to do it that way, because there are instances, or there could be instances, where the client also purchased items through I don't know, through credit agreements, maybe an intercompany loan type of thing where another company paid for that purchase or something like that. So don't just assume that, but in this case, because the working paper has confirmed to us that the only cash additions were made, we know that this could technically go and agree to the additions. Cash proceeds from the sale of property, plant and equipment, those all reference to the working papers. If we just look at the operating activities, we had the interest, we had the tax payment. So we spoke about all of those. Good. So now we can go and actually audit this now. Right, so let's just think about this. We said, where's my slide again? Before, when we said, what is the approach? What is the transaction? What is the section? Statement of cash flow. What are the framework requirements? Well, the framework requirements is that you have a specific layout that you must use. You must remove all non-cash items because we are talking about actual cash flows. You must show the gross movements, not the net movements. So those are basically your framework requirements, and we need to go and make sure that when the client did all of this, that was actually done correctly. All right. So let's go and see when we go back to our working paper, which is the Excel, and we go and agree it to the client statement of cash flow. So here, I want to just move this a little bit. Okay, there's our client's information, which we are going to import now. And then what we need is we need a difference column here, just in case there are differences. We want to make sure that we have those as well. Good. So now you can see with me, oh, goody gracious me, now I've hidden half of the statement of cash flows from us. Let's make it slightly smaller. Oh, that's probably too small almost for you, These a little bit smaller. Then we can fit everything on. And then we can make the statement a little bit bigger again. Right. There we go. So now we are going to actually take what the client has put in their financials and copy it to column F essentially, and then see how does the client's draft financial statements compare to what we believe is necessary, what should be on there, what our audit evidence shows. And that I want to remind you of again. What we have here on the left-hand side of our Excel working paper is our audit evidence. We have evidence of the non-cash flows. We have evidence of the gross movements, all of that. Even though it might not necessarily be, I was going to say, evidenced or proven on this working paper, we have referenced it to where it is documented, where the audit evidence is on the rest of the audit file. All right. So let's go and see when we go to the client's statement of cash flows and see what have we got there. So in terms of calculating the cash generated from operations, we need to go to the second page, which is where we then have the cash generated from operations. So what do we have there? There we have the client's number. I hope this is big enough for you. Otherwise, you must just increase the what is the word? The zoom on your side if it is a bit small, because I just find it's easier if you can see everything that I've got on there. Okay, so the client is showing a net profit before tax, and they have determined that to be the following. Let me just make this numbers because otherwise we're going to struggle to see. Good. So here we can basically say what is the difference, and we're going to say the hours less the clients, and they obviously it shows you. I mean, that's easy enough to see they agree, but we can now basically just pull this down all the way to the bottom. We're not going to use all of them, but I just find it's better if we actually use it like this and then delete the ones that we don't need than having to copy, paste, copy, paste, copy, paste every single time. Right, so that's what the client's got on these financial statements. Then next up, they have adjusted for non-cash flow items. So they don't have this detail here, but we don't need the detail. So that's fine. We can delete those ones. Then for non-cash flow items, they have also, oh goodness, they have also adjusted for depreciation, and their depreciation they've indicated to be 11172,888. There we go. Oh, perfect. No surprise there. Then they also have a profit on sale of assets, and their profit is minus 152,890, and there another one that's cleaned out. But what do we see? They don't have any other non-cash items adjustments here. So basically, they are missing all of these 3 items. So I'm going to maybe just highlight those 3 adjustments for us for the moment. Let's choose another color, maybe orange, to know there we already have a problem. The client's already not taken out the unrealized foreign exchange profit, which is a non-cash flow. It's an accounting entry. They have not taken into account the non-cash movements in loans to group companies, and they have not taken out or considered the non-cash movements in loans from group companies. Can I just remind you, what did we say was the risk that we identified for the statement of cash flows? We said the risk is that the client is not going to remove the non-cash flows. So here is exactly now what we thought was going to happen, and now we've proven that the client has got it wrong. So here we just need to make sure that we will get the client, we'll obviously report to the client to make sure that it's right. But let's not run off to the client just yet. Let's see, the full extent of our problem. Good. So then they are adjusting for items that are separately presented, and we have a very similar matter here. We have investment income, which they have disclosed as 513,755, and we have dividends received, which is 679,6765, and that's the same. All right, those are the 2 amounts that they have included and that we have included. You can now put a strike through or whatever each of these if you want to, as you need to. Okay. What we are identifying though is this finance cost one. Okay, what are we seeing there? We don't, I didn't include in the case study, we didn't include the prior numbers. So obviously for the prior numbers, you would have agreed them, very important, to the signed financial statements from the previous year, not to the previous year's audit working paper or whatever the case may be, draft financials from a prior year. You would have agreed the prior numbers to the prior signed financials to make sure that you're using the final version of that statement of cash flows, right? Let's imagine that there was a balance in the previous year. Then there's nothing wrong with having just a 0 this year, perfectly fine. But if there was also no balance in the prior year for finance costs, then this could potentially be obscuring, be filling up the statement too much and actually be unnecessary disclosure. And we may actually ask the client to remove that. Okay. So that's entirely possible as well. Right, next up then, changes in working capital. So we seem to be following the same process. Now here also, if we just think about this, we spoke about the finance cost there, but here also you are seeing this additional part that says decreases. I mean, if we only have the negatives, those are increases, then actually you only need to show increase in inventory, and of course without the brackets. Again, there's a negative, so that's an increase. And so again, without the brackets, you can just show increase, you can leave out the decrease. And on the other side, you can say decrease in trade payables, and you can leave out the increase part there. Okay, but let's see what they've got. So changes in working capital. For inventories, they have minus 28,653,448. That's exactly it. We don't need to go and get the information. They didn't disclose the information of the opening and the closing balances. That's fine. For trade and other receivables, we have 189,67457. That does not agree. Look at that. There's a difference. Okay. And what do you see in terms of this difference? Do you see that it is basically the same as our unrealized forex balance? That's the same one. 404, 403.50. So what we know is that they've obviously accounted for the opening balance and the closing balance, but again, they did not account for the non-cash item, the unrealized foreign exchange. Right, so we're almost not surprised, but all right, for the moment we are surprised because we obviously hope to not have any issues. Then trade and other payables, there we go, that last one, minus 31. You can probably already see the problem here, because there's minus 29, and here we have minus 31. And again, similar number to what we have, and no surprise, the unrealized forex. So again, the client has both at the top, where we were addressing the non-cash items, not removed it, and also for the trade and other payables and the trade and other receivables not address the non-cash item. So they are showing a movement in trade and other receivables that has both cash flow and non-cash flow. And we only want to see the cash flow element included there. Good. Then what do they have as the total for cash generated from operations? Well, there they then have 26,734,738, which is the 7 million rand difference. And that 7 million rand is actually then the other two that we have, the 7272. And that is exactly what they've got as well. So if we just look at the difference there, 7272,819, they have 7272,819. So the two have netted off the unrealized forex exchange profit at the top and at the bottom. They've netted off, but we still have this non-cash movements in loan companies. That's a problem. Good. And then interest income there. Now we go to the actual face of the statement. Before we go there, let's just quickly do the tax paid, because there we have the note. So we've got tax paid here as well. Tax paid, and what did we say is the tax paid? Also, yeah, let's just show that one there. So the tax paid in their statement is 14643,670. And thank goodness the tax payment is the same. Okay, so no cash issue there. All right, let's go to the face of the statement, and then we see what else we have there. So face of the statement, we had the cash generated from operations. There we already had that 7 million difference. Then the interest income, that is thankfully the same. We already know that from earlier on. The client has the dividends also. Correct, that was probably cash dividends, if I can put it that way, eh? So not in kind, because they obviously didn't get that non-cash items there. And then the net cash from operating activities that they are reflected is 19401,588. No surprise there then that we have the 7 million that's still carrying through from the operations. Then in terms of purchases of property, plant and equipment, on their note, they've got minus 96171. Goodie, 121. I almost want to say probably the only reason why that is correct is because we only had cash additions and not non-cash additions. So thankfully that's helped us there. Proceeds from the sale of the PPE. So there also only cash sales, so that was good. And then look at this, cash advance to group companies, cash received from group companies, and they have nothing. Look at that. So they are missing 2 lines there as well. And so we will, for the moment, also highlight them and say problem, problem, problem. So now what we have then is the net cash from investing activities, which is essentially that one plus that one, and that gives them 9375121. That's exactly the same. Right. Again, we have the difference. That net difference of 1.3 million is, of course, the 2 cash issues from the group companies. Repayments of group loans, do they have that for their financing activities? So cash flows from financing activities. Look what they've got. They've got movement in loans, and it's a minus 1 million. Repayment of group companies is 3 million. So they don't have the same things here. Let's just go look at the next one. Proceeds on loans, 3.5 million. Movement in loans to group companies. The one is from and the other one is to. So those are totally different ones. We're going to actually add extra lines in there. I'm going to add 2 new lines and then rather type in their information there. So they've got movement in loans from group companies and movement in loans to group companies. Okay, we obviously have 0 and 0, and then they have minus 1654368 and minus 3908861. What do they have for dividends paid? We have 10.5, they have 10.5. So thankfully those agree. Now if we pull these differences down again and then have the total, then they have 16,063,000, we have, and they 16 million, and the net difference is 5 million. So all of these together, 5.9 million, right? And then the total cash flow for the year that they have, so there they have the 6 million. If we just add all of them together, so net cash from financing activities, from investing activities, from operating activities, that's the same. So whatever issues we have up here, they actually all cancel out. Just quickly do those ones as well to show they are issues. And yeah, so that, and then of course the cash at the beginning of the year, they have that as the same. So that's also 4,112,6,183, and the cash at the end of the year is then, if we just add these two together, hopefully that also shows, yes, 35,089,421. So first of all, our cash flow balances, their cash flow balances, which is amazing, but they don't have everything correct. Now, what do we have? Let's just have a look at some of these things. So one of the problems that we have identified is they obviously, we've spoken about the non-cash items that we know about. But the other problem that we have here is that they haven't correctly classified the cash movements. So there were cash advancements to group companies and cash receipts from group companies, and those are investment activities. But they've moved them below that line to financing activities and just grouped, it sounds funny now, grouped all the group entities, grouped all the group company movements together in two lines. So that is actually a classification error. So we need to actually get them to fix that, to split out these two numbers between what is in fact financing activities, repayments of group loans and proceeds on loans from group companies, which are financing, and the investing activities, to split those out. Okay. Right, so those are our errors. The non-cash that they did here at the top, or that they didn't show, and then also the what did I want to say now? Also the classification issue. I just wanted to also maybe highlight that the tax, did we reference? Yes, we've referenced those two lead schedules, so that should be fine on the left-hand side. But on the right-hand side, you could actually also stipulate that you have, in fact, seen these three line items, that they have disclosed those correctly. You could have also allocated or shown that to say, agreed to note 19, because remember now that we go and have a look at this. That's not part of the cash flow statement. So if somebody's going to go look at the cash flow statement, they're not going to see the tax paid calculation. But that is note 19 of the draft financial statements. And that for all three of those points. And then we can even make them bold and green, because those are, of course, our audit evidence notes. Okay, so just to show that we have actually traced those to the financial statements as well. Why? Not so much because we want these ones to be traced, but because we need to have all of the information in the financial statements referred back to the underlying records. Okay, so that's actually what we're doing. Yes, of course, you could also reference this back to the financials. You could reference from the lead schedules too, but seeing as we are here now, we can just as well do it like that. Right, so that is really then the issues or the points. What we are finding here is that there are then basically four parts here. And first of all, we would go to the client and say, Mr. Client, this is wrong. Please, will you fix it for us? And ideally, you want the client to fix all of it. But in this case, we are saying that the client has said, you know what, I'm not going to actually fix, not all of those. I'm not going to fix the unrealized forex. It's not material to the users, and we're not going to do it. It's an in and an out in the same note, doesn't affect the users, and we're going to keep it like that. We are not going to change it. So there, we will then add a note here on the right-hand side. Just going to call it note 1, same bold and green. And let's just copy that over to the other 2 as well. Oh, my word. Those 2. And then actually write a note about them to say what is the case. Now, remember, we haven't got a specific materiality number. So we will assume at this point in time that it's not going to be quantitatively in terms of numbers material. But qualitatively, we'll have to see if that is material or not. But that's not what we are going to necessarily determine right this minute. But it is definitely something that would need to be considered. So what will we document there? I've actually prepared some information for us to just see, just so that you don't have to see me typing everything. I mean, you've already seen me type so much, but let's go with this for the moment. So I'm just going to actually put in a note here, and then we can discuss it. Okay, so I've typed here to say the client has eliminated the unrealized foreign exchange differences on trade receivables. Oh, sorry, that's not eliminated. I was thinking now there is a problem. Has not eliminated the unrealized foreign exchange differences on trade receivables and trade payables. This is a misstatement, and management has indicated that they are not correcting this because it is not material in the context of the statement of the cash flow, cash flow statement. And they are, these differences are therefore taken to the uncorrected disclosures, misstatements, working paper. Okay, so we're going to look at that later on. So they say it's an in and out in the same note. It is what it is. The other problem that we have are, of course, those non-cash flows. Okay, so still higher up. There we have some non-cash flows. Just going to make it into, and that is non-cash flows there, but then also the repayments and a lot of those other ones that are all non-cash flows. So you could even add them to these ones also to say that they are potentially also all issues on the movement in the loans to group companies. All of these ones are also actually non-cash flows that have not been fixed. Okay. That should have been highlighted. Oh, goodness. Right, so what is our note there? In this case, we went to go speak to the client. We said, listen, we really believe this should be right. Please fix it for us. And they said, all right, we will fix this. Give us time, we'll fix it, whatever the case may be. So now, someone made it bold, eh? Now we're going to go and again say, put the note there, say the client will fix this. Now it's bothering me that it's different font, apologies. The client said he or she will go and fix this, but it's not been fixed yet. The statement is still the statement. We are still seeing what we are seeing. So we will probably highlight this or have it as a note or something like that until we get another version where we can see, it's fixed, and then we'll go from there. All right, so at least the client has said they will fix it, but this non-cash movement, but for the moment it is still not fixed, and therefore we're going to keep the note there. Until it's corrected, then we'll probably just add another column here towards the right-hand side, show that it has been corrected, reference it to the further draft, hopefully the last draft, reference it there, and then we can remove this note. What we will probably not do is to completely remove the column that we have of this first draft, because sometimes it just tells a better story if we can say draft 1, draft 2. Right, but if you really want to, then I guess you could also delete this draft and just make it your final one. So if we just look at the errors, we're then addressing all the errors from the top. Here we still have 2 issues, and those ones are the cash advanced group companies and cash receipts, which just has been completely skipped, if I can put it that way. So yeah, I'm going to just make it note 3. We've already done note 2. So for note 3, the clients completely skipped them, and I'm going to actually That's the classification problem that we have. And I've probably then moved them also into these other two, into the movement in loans to group companies. So I'm even going to add there to say there's also an issue there. Okay. Then for note 3, our comment there would also be, client, please fix it for us. And for some reason, they are happy to fix the classification. Maybe they didn't know the best way to do it in any case. So they're just glad someone's willing to help them, to show them how to do it. So they fix it. Clients classified to group as classified loans to group companies incorrectly under the financing activities should have been investment, as we said. We've discussed it with so-and-so, what's their name, who has indicated they will correct it. Not corrected yet, we stick with what we have. Okay, sorry, now I see it's still note 2. It should have been note 3. And then our last issue was the gross. Remember, they did not actually net them off. So the last issue we have is, in fact, also in this one, in 4 and in 4. And here where they are showing the gross movement and not the net movement. So again, let's make this in 4, and the client is just not, sorry, they've shown the net. Now I'm not sure which way I said it. They've shown the net, not the gross. So we want the client to please fix this. I said that's fine, not a problem. They will fix it. All right. That is our statement of cash flow. Any comments, any questions? Good. All right, we are not done yet. We are going to move to our second exercise. We're going to look at the related parties next. So if I just go back to our work folder, we have the related party note that shows the financial statement disclosure. And that's all there. And then we also have a working paper where we can document the disclosure. There we go, related parties. All right, so again, I'm going to just split my screen. This working paper is a bit bigger, but more columns to it, but we will make it work. Right, so let's just see what is on this working paper. So maybe, first of all, related parties, and specifically I'll focus on related party disclosure, because remember that transactions with related parties, let's say, for example, imagine the client rents the factory building from a related party. We've already audited the rental expense, for example. Or if we have pay salaries to a person, or directors remuneration, directors emoluments, whatever, we've probably already tested that it is in accordance with the agreement, or the, done the actual calculation of the number itself, recalculate, check it to the contract, blah, blah, blah. So that audit work has probably already been done. When we think about related parties, we are specifically interested in whether the transactions and balances, and then of course the actual related parties and the relationships with them, whether that has been properly disclosed in the financials. That's what we are concerned about. And in fact, there's a whole separate standard in auditing standards about related parties, and I almost want to link to that, related party disclosures. All right, so we've probably already got the audit evidence, and as we're going to see now on the working paper as well, the evidence is all there. It's almost similar to what we had in the statement of cash flows, where we have all the information. It's been audited somewhere. Now we just want to go check if it is in the financial statements and correctly in the financial statements. All right, so as a reminder then also, because we said that the client may potentially actually not show the disclosure, we had in this case, we had recorded a significant risk that it may not be correctly disclosed. And because it's a significant risk, we need, I almost want to call it, very persuasive evidence. So it's not just a medium or a low risk or something like that. And also remember that it's possible that you might have instances where the related party disclosures doesn't actually have a risk. You haven't identified an inherent risk factor that leads you to want to record the risk for related party disclosure potentially being materially misstated. But if you consider the related party disclosures to be qualitatively material, in other words, even maybe sometimes in rand values or in currency values, so quantitatively, but most likely your related party disclosures are going to be qualitatively material rather. And so in most cases, you're probably going to end up auditing and checking that the related parties disclosure note is correct. And remember also, if I think back to our slides now and we go and we think about our approach, that we have the related parties, the framework says what must be disclosed, and then we go and we check for audit evidence for that disclosure. We audit the actual disclosure, check it there, but then look for the audit work. So that's where I want to go. Make sure then that we have the audit work to support that disclosure. All right, so back to the working paper that we have. I'm going to actually just close the one from the statement of cash flows because now I'm getting confused with what I have where. And there's our note then on the related party disclosure. All right, so what do we have on the left-hand side on our working paper? So again, our team member, Helen Miller, has gone and done a lot of stuff for us already. She has already listed the list of related parties for us and agreed to the parties identified at the planning stage. And even here, then put notes for us to say she's also agreed to the CIPC documentation. So we know the directors are Emily Harper, Kathy Fritz, Larry Attic, Stefan Harper. Close family of the director is Susan Attic, which is Larry's wife. So that's also been agreed to the director's declaration from a meeting held on a specific date that's been disclosed or that's been documented by us. Then there's a company or companies rather two that are controlled by the directors, and those are Wrap-Up Manufacturing Properties and Plastic Friends. Right, again, agreed to the director's information from the CIPC, where you get those records from the CIPC. And then lastly, a shareholder in Wrap-Up Manufacturing with significant influence, so not our parent company, but it does have significant influence, is the Larry Attic Trust, and that again has been agreed to the CIPC documentation to show that it is in fact a shareholder. So throughout the file, with all of the evidence that's been obtained, the following has been shown, reflected, disclosed. So we're going to get to the financial statements just now. Feels like, okay. We're going to get to the financial statements, but let's just see what we have in the current year numbers. So Plastic Friends is 190,000. The tick marks here at the bottom, APA shows that it's been agreed to the payables age analysis. Stefan Harper is there, balance outstanding, and you can see to the lead. Larry Attic Trust has no balance in the current year. Prior year had a balance. And then important here where we say the loans are unsecured, interest-free, and have no repayment terms. Right, that is part of the working papers. Now, here what we will need to do is we'll actually have to go and see they say the loan terms have been agreed to sign loan certificates and the prior signed financials. So that's already been done for us. So we just need to see if this is disclosed correctly in the financial statement. So we know the loan terms are correct. We know the values. We just need to go see if it is properly disclosed. And then transactions, the rent expense for manufacturing properties, there is the 2.7 million. AGL is, of course, agreed to the general ledger. And here we can see it says the information was extracted by the engagement team and the amounts have been agreed intercompany as well. Larry Attic Trust interest paid, nothing in the current year, and that agrees, and the same with the prior numbers. Wrap-Up Manufacturing Properties repairs and maintenance paid, or received then rather, received 416, agreed to the general ledger again, and salaries. So Susan has received salaries, and that's again being agreed to the payroll report. Okay. Then we have a note or just comment here on the audit working paper to say we have to look at the director's remuneration testing on working paper 75035, where detailed information is included about the director's remuneration. And that is because the related party disclosures require key management personnel compensation. The Companies Act in South Africa requires certain companies to disclose the director's remuneration. and then with very specific requirements. Right, so that's just almost want to say to highlight the, how shall I put it, the framework requirements for us then. Okay, so let's go and have a look at what is disclosed in the financials, and then we can see whether this is correctly done. So in the related parties note, what does the client have? So they're disclosing the relationships. So if we just look on the left-hand side, they have close family of director. So that is, of course, Susan. So that's fine. That is disclosed there. And we can probably also just mark it there as agreed to the financial, something like that. And then also the same, you can actually reference this back to our working paper as well. Then the next thing that's been disclosed, the company is controlled by directors. So that here includes Plastic Friends. But what do we know? We know that our record shows 2 companies. So what we are missing here is that wrap-up manufacturing properties is not actually disclosed. I'm going to highlight that in our orange from earlier as well, because they are only showing the one company, not the other one. Then shareholder with significant influence, we've got the Larry Attic Trust, the directors, members of key management there. We've got 3 directors there, and here we actually have 4 directors. Who are we missing? We seem to be missing Kathy Fitz. Okay, so there's another problem that they are not actually disclosing here. Right, so those are just the relationships where we already have some problems. Then next up, and remember, this doesn't mean that the client's necessarily hiding them from you, because this probably comes from the planning stage where you've already identified them through discussions with the client, all those things. They might have, technically speaking, they might have just forgotten to add them to the disclosure for whatever reason, or they might not have been very sure, or whatever the case may be. So we'll need to highlight this or point this out to them and say you are missing one of your directors and you are missing one of your company's controlled relationships. Balances, outstanding, and these ones here is really then basically what we could show you in as the notes that's already been included here as per draft financial statements. Stephen Harper, 134,326 Rand. It was obviously a little bit different, well, 325.56. So that's obviously just a rounding difference, so that's fine. The Plastic Friends, so that's loan accounts owed by the related party. That's Stephen Harper. Larry Attic Trust had nothing. We confirmed that earlier on that Larry Attic had nothing there, right? And then what do we see here in terms of the loan terms? The loan is unsecured, interest-free, and has no repayment terms. And that's exactly what we have in the financial statements, or what we have in our records. So we will probably then make a note here below this. I'm going to again make it in green. To say disclosure of loan terms agrees to the draft financial statements. Okay, then we know that's done. So we have said here that we are just agreeing the financial statements to the information to the financial statements, and that's good evidence. And then just in terms of these words, we're also indicating that they are in fact agreed. Next up then, so those were the loans. There's amounts included in trade payables, Plastic Friends. So that is a balance outstanding. There we've got trade payables, Plastic Friends, 190,000. So that one is also in there, just the rounding 7 cents. Those are the outstanding balances. And here also you can see balances, and then we move to the transactions. So now transactions, firstly, we've got rent paid to the properties company. So the information is disclosed, same amount, no rounding differences, thankfully. But remember, the problem with properties is the relationship is not disclosed. And the requirement says you have to disclose the balance of the transaction as well as the relationship. Interest paid to related parties, so there was nothing because the loan was not outstanding, or the loan was paid back, so that's fine. Then repairs and maintenance, again with regards to the properties company, the amount agrees we see, so that's all fine. And then the salaries and wages, that's also disclosed and all good to go. Then we've got this reference to the working paper, and we don't have on this example, I didn't give you every little detail about it, but we do have a note for key management personnel compensation. And we also then have the detail for the, I'm going to actually just make it slightly bigger. Yeah, the detail for the director's remuneration. So essentially, key management personnel compensation, that one at the top agrees to what is required by the related parties requirements. And then the director's remuneration per individual director, all of the information here per each of the class of what they need. That is what we need disclosed for the director's remuneration in terms of the Companies Act requirements. What may be possible is that the total amount for the current year may possibly agree to the total emoluments, but that's only if the key management personnel compensation includes only directors' compensation. Okay, so it is actually possible that the key management personnel may have more individuals in there, and therefore then these two amounts will not necessarily agree. Right, so that feels like quick and easy, but now we need to do something with the findings we've had. We can't just leave it there. And so now we will have to actually go and get make a note here to say, what are we going to do about this? So we've got the notes already to say no prior amounts noted in the signed prior financial statements for where there were missing numbers, like here with the wrap-up properties, repairs and maintenance. Number 2, where's number 2? Let's see, number 2. It says inspect the disclosure in the draft financial statements and compare the disclosure requirements to IFRS for SME, and no exceptions have been noted, right? So that's also been just documented generally to say we haven't found any. But now we actually have a note 3, so to say, maybe also just to copy that one to say, where's the problem? The problem is either here with the transactions, that's the rent expense pay, that's the repairs and maintenance, and I guess one could also say, yeah, by wrap up manufacturing, the relationship, if you really want to. Oh my goodness, now I've lost my int 3. Okay, if you really wanted to, you can go all over the place wherever it is. But at least we want to indicate that we have the problem and that we're going to deal with it. And so again, we went to go and discuss it with the client. We said, here is a problem. Please, can you fix it? And the client said, yes, happiness, they will fix it. And so here is our note again. Let me just merge and wrap it again to say the relationship with properties is not disclosed. We've discussed it with the client. Who this is, we need to obviously include the name. All right, I see I've just got a name, so not the financial manager, the name of a person when we had the discussion also, who has indicated that they will correct this. Right. And so then we are comfortable that the related party disclosure note is right. Now, maybe just another, I want to say another flavor here for us is that we went to go and look at the requirements from the standards. This is the IFRS for SMEs, requirements for related party transactions. You can say what must be disclosed. I've talked about them now, but maybe let's just have a look at it and see if we've covered everything. So firstly, we should disclose the relationship between a parent and its subsidiary, disclose that irrespective of whether there's been related party transactions. Now, the good news, there aren't any parents or subsidiaries, so there's nothing for us to be disclosed, so that's all fine. There's just no parent or subsidiary. Then, secondly, so we could actually, if this is like almost like our disclosure checklist or something, we could document here to say no parent or subsidiary relationship, no disclosure required. Let me just wrap this, otherwise we're going to not enjoy this one. Okay, number 2 then. Number 2 says an entity shall disclose key management personnel compensation in total, and then explains everything that should be there. All right, so that's there. Happiness, we have that in total. So we don't need the details, just one in total, and that is disclosed. I'm going to say disclosed, but probably mark something in a bit more detail to say where it was, if you need to, or if you want to use this as a working paper. Also. Number 3 says, if an entity has related party transactions, it must disclose the nature of the related party relationship. That's where we had the property problem, as well as the information about the transactions. Okay, so there we've got the amount, the terms, all of those things. So that is all there. Just again, remember, we can't just agree this to just numbers. We need to make sure that these things have actually all been audited. So again, going back to our slide to say, audit the disclosure, yes, but also make sure that there is audit work behind that disclosure. Now I want to go back to my document again, right? Then, okay, those transactions are all there, and we could probably say something like missing disclosure of relationship of wrap. I'm just going to say wrap up manufacturing properties or disclosed. Right. And then when we get to number 4, an entity shall make the disclosure required as per the previous requirements separately for each of the following categories. And there then, entities with control, joint control, significant influence, and so forth. So that is there, we can just say the disclosure is sufficiently detailed. All right, so we've got enough. I mean, there's a lot of details here, so that's fine. And then number 5 says an entity shall not state that the related party transactions were made on terms equivalent to those that prevail in arm's length transactions unless such terms can be substantiated. So this is a tricky one sometimes to auditees, or audit teams. There is nothing that says we must go and audit that it is at arm's length transaction. The thing says if the client states that the transactions are at arm's length, so that is part of their disclosure, then we need to make sure that what they are saying is accurate. And so if they do state that the transactions are at arm's length, then we will have to go and actually go and check that that's the case. So we would have to go test for that. Maybe look for similar transactions that's not with the related party or with a third party, get benchmarks, then the work starts. But if they don't say anything about this transaction, these transactions, they are completely quiet on arm's length transactions, then we don't have to go and do anything about it because they are not making a statement that we need to go and audit. All right. And also remember, we did say that we are concerned about transactions outside the normal course of business. That's part of your generic fraud response if you want. But transactions outside the normal course of business is not necessarily transactions not at arm's length. Outside the normal course of business could be other than what you normally do as part of your business. So renting a property is still part of our business. Repairs and maintenance could still be part of what we need to incur as part of our business. All right, so that could also be helpful for you to then document how you go about considering the financial reporting framework requirements when you go and audit the related party notes in this case or other disclosure. Good, that was our exercise. I understand that there is a question, but then also that I think Helen said she will respond to it, so maybe that is fine. So yes, so that I see Helen is busy with that question, so I'm just going to carry on. That is more with regards to mapping and not so much about how we audit it. So I'm just going to carry on and we can do the rest. All right, so still in related parties, disclosure, but now having completed the exercises and seen where the issues are, we now need to evaluate the results or the misstatements that we found as part of doing this audit work. So when we come across misstatements, we need to ask ourselves, are these misstatements or is this misstatement material? Considering in terms of materiality, whether this is individually material, Okay, so this one item where we know that the relationship is not disclosed, is that material individually? Cumulatively, if we think about all of the misstatements that there are in disclosures, so if we think about that statement of cash flow, so it's not just about the foreign exchange non-cash that's an issue. It's also about the non-cash flow and the netting off and not classification, and all of those together may be considered to be material. The next question then is to say, does this misstatement affect the fair presentation? Fair presentation, does this prevent the client from really understanding what happened? And so some considerations there. Persistent. Is this a continuous problem? Pervasive? Is it across the whole file or many of the elements? Is it almost everywhere that it really is difficult for the client to understand what, I almost want to say, what is actually correct, what is fine, or really get to an understanding? And then, of course, if there is a number of misstatements for the same matter, that also could affect the fair presentation. And the next up, in terms of whether this is fraud, whenever we have a misstatement, we always ask ourselves whether this could be indicative of fraud. And there, of course, is there an intent to mislead the user of the financial statements? So if we are adding lots and lots of, I almost want to say, unnecessary disclosure, or adding those line items in the statement that doesn't have balances, is that with an intent to mislead or not? And then also, as I mentioned now, the duplicative and the uninformative disclosures, maybe that is also there to try and hide, I almost want to say, the important information from the users, so that they get so inundated with all of the other information that they might actually not get the real message across. I'm not saying whenever someone has too much or uninformative disclosures, it's always fraud. So it is also quite possible that the client's just not sure what should be disclosed or how to do it or what they can actually leave out. So we also need to consider that that might just be the case. I just want to say, like, an honest mistake, but we need to also ask ourselves whether this could be indicative of fraud. Right. That we're going to go into a breakout very soon, and then actually look at this and see how and where do we consider and document our evaluation of the misstatements in disclosures. But before we do that, I want us to just also almost want to say, see where we are going in terms of audit level 3, and then we'll go to our breakouts, because as you know, once we're in our breakouts, that's then basically where we end the sessions. So let's just quickly first see what is then left, or what is next in audit level 3. So we've done the finalization of an audit. We've dealt with today then in how to audit disclosures. And in next Friday's session, we will deal with how to review an audit engagement. So that is in terms of reviewing the actual audit evidence, the working papers. Right, so that is what we are going to look at in the last session, session 3 of level 3. So I really hope that we will see all of you there again next week. All right, but that then brings us to the breakout sessions. Now, some of you may already remember that when we get to the breakout session, we do not actually break into breakout rooms, just because that doesn't seem to work as effectively. So what we are rather going to do is we are going to have all the probe users stay within this session. So in this Teams meeting, you don't go anywhere. But then I've just linked a Teams link for another meeting where all the Audit International users can go to. So Probe Audit Premium Plus users, you stay in the session. The other users, you can then join that meeting to go and listen to and hear what Samu is going to tell you about Audit International and what she is going to show you